The world didn't come to an end just because gold doubled and doubled and doubled again. We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers. Welcome everybody to Talking Trades. You have Kevin Wadsworth, Northstar Charts, and myself, Patrick Karim, Badcharts. And today we're going to talk to you about gold and these crazy targets we might hear sometimes, like let's say $10,000 gold. But using objective price analysis, we're able to actually showcase you when a move towards 10,000 is possible and how much time it could take to get there. And is it reasonable to even get to $10,000 gold? So to mitigate your expectations, Kevin's going to do a little showcase here on what's the actual roadmap to those lofty targets for gold.
Yeah, thanks, Pat. This is where technical analysis really helps us to put some evidence together when we hear these numbers spoken about: $5,000 gold, $10,000 gold, $15,000 gold. As you say, a lot of clickbait headlines there, but just how realistic are they? And if they are realistic, are we talking about 5 years from now? Are we talking about 10 years from now? I mean, when exactly? How long does it take gold to move from $2,500 to $10,000? So I'm going to start with a chart, and of course we always like to look at some objective evidence, and you find that on the price chart. So what we're looking at here is the S&P. This is the S&P 500 index, the SPX, and we're looking at the last couple of bear markets for the S&P and bull markets for gold. So you can see these annotations on the chart. 10 years it took for the S&P to recover its previous highs from the early 1970s all the way through until the early 1980s. And during that period, of course, we saw gold going up by hundreds and hundreds of percent. The gold price doubled, and then it doubled again, and then it doubled again, and then it doubled again, and then it went up some more. And a similar sort of thing happened during the early 2000s. So the stock market rolled over, it broke support, and we entered a 13-year period between 2000 and 2013, during which the S&P did not regain and hold on to its previous highs. And that 13-year period was also a gold bull market, or a gold bull era, actually. Now, these extended periods of the stock market going precisely nowhere for a decade or more is what we require for a gold and silver bull market to continue for an extended period of time that allows us to get to these lofty targets that we've spoken about. The important thing to notice here is that the precious metals bull market era ends when the stock market regains its previous highs and starts moving on to new highs. So you can see 1981-82, that's when the gold bull market ended. And then you can also see in 2012, at that point there, the gold chart topped and it broke down and it entered a bear market. So that's when gold reaches its peak. So we can move on to where we are today, and we can have a look at what's happening now, and we can make some sort of roadmaps or suggestions about what may happen if and when this chart breaks down. So one thing we can say is that it won't be until the chart regains those previous highs again that the gold bull market is finished. So let's just assume for a moment that the S&P goes up to 6,000. Could be 7,000, it could be 8,000, but whatever the number is, let's say 6,000 for now. And then it breaks down and it rolls over and it does what it did before on all of those previous occasions, and it falls at least 50%. Remember, it fell 50% or more twice during the early 2000s. So it'll take a drop of that sort of magnitude. We've discussed this before. It'll take a drop of that sort of magnitude to create the environment that precious metals require for those lofty targets. Now, those lofty targets, what are we talking about here? Well, as I said, gold in the 1970s, it started from, let's say, just over $100, $120. It doubled to $200, $250. Then it doubled again to $500. Then it doubled again to $1,000. And then it went up some more, or it peaked actually at around about that point. So it doubled, and then it went up some more. In the early 2000s, we started at around about $250 there. price doubled to 500, it doubled to 1,000, and it doubled to 2,000. So that's 1, 2, 3 doubles. Now, from the recent bear market lows, let's say they're around $1,000, a double would take it to 2, another double would take it to 4, and then another double would take it to $8,000. So anywhere around that sort of 8,000 area seems reasonable given past evidence. So obviously what's happened in the past doesn't guarantee what's going to happen in the future, but we're starting to build a picture here that gives us an idea of what is perhaps achievable, reasonable. It's happened in the past twice, so there's nothing in particular to stop it happening again. The world didn't come to an end just because gold doubled and doubled and doubled again. And we've also been going sideways for a very long time, actually, for gold. So, over 12, 13 years, 14 years, gold has been going sideways. So that's a very long period of consolidation and effectively going nowhere. And we're just breaking out from that consolidation period. Now, to take a look at some evidence for this process taking place, we can strip out the weighting from the S&P, and we can use the equal weighted SPX. This is the SPXEW chart, the S&P equal weighted chart. And you can see these periods of capital rotation that we've spoken about before, when the chart starts to rotate to the downside or rotate to the upside. And that's when fund flows, capital flows begin to favor either the stock market or gold. And we are seemingly in a period now where the rotation is taking place away from the stock market, away from the stock market and towards precious metals, towards gold, because we're breaking down below support. We're breaking down below support again, and we're very close to breaking down below support again. So it's a series of pieces of growing evidence as this chart moves to the downside. And we've already doubled. We've moved from at this point where we touched the top of this inverted arc at $1,200, we're already up to $2,500. So we've doubled once. So if we doubled again, it would be 5,000. And if we doubled again, it would be 10,000. So it seems reasonable on this chart that as we progress towards the bottom of the chart, that we would be somewhere in that region of $10,000 gold. And this gold to S&P ratio says the same sort of thing. As the chart moves to the upside, gold is outperforming the S&P. And as the chart is going down, gold is underperforming the S&P. And you get these rotation events. From the top, it rotates. From the bottom, it rotates back up. From the top, it rotates down and then back up and then back down. And now we're in a process of rotating back towards the upside. Now, if we move through this solid red line and the rotation is confirmed, then we can start to look at some values on this chart here. And if, as I said, SPX is 6,000, then we can make some estimates as to what gold will be. So if the SPX does reach 6,000, then at a ratio of around about 5 on the gold to SPX ratio, gold will be $30,000. Seems a little bit extreme and perhaps a little bit too greedy to expect that. So how about if we get a ratio of 3-1 on the gold to SPX ratio? That'll give $18,000. This is, by the way, at the end of the gold bull market, as gold is breaking out. As gold has reached its top, and the ratio is breaking back in the other direction. So at this stage, the gold to SPX ratio would have peaked, and the S&P is breaking out above its previous all-time highs. So this is when the S&P regains that 6,000 level, and that's when gold peaks. Now, if we only reach this black dotted line, this one here, which doesn't seem like a very greedy target at all, because we've been above it several times in the past. But if we only get to 1.5 on the ratio, and if the SPX is 6,000 again, as it starts to break out again, that means gold will be $9,000. So my conclusion from this is that gold at $10,000 is entirely reasonable, entirely achievable. It fits in with what's happened historically in the past. And so a target for me, my personal target, is anywhere between $8,000 and $12,000. But those higher targets are not impossible based on the evidence. And that's it. That's my bit on the gold target and $10,000 gold.
That's right. That's great, Kevin. And also, guys, notice that last chart that was on the quarterly chart. So that's on the 9,000 was on a quarterly closing basis. So it doesn't mean that intra-month, there's always like some type of euphoria melt up. And that's where instead of that 9,000, you get 9,500 or 10,000 or 11,000 when everybody goes bonkers. But we'll know by that time that we'll be stretched, right? So remember, these lofty price goal targets doesn't mean that's the price, it's the baseline. No, it's the opposite. It's the high end game target. So that was brilliant. Guys, thanks for watching this episode of Talking Trades. Make sure to subscribe and follow so you can get more good content like this. Thank you.